Hey everyone, it's Reid Johnson, president of Lake Point Advisory Group. I hope you're having a fantastic Friday. I was just talking to Heather before we got started. There's a plume that is in the air right now, and she's like, obviously, I haven't been watching the news. So, for those of you that don't know, there is a big dust storm that has come from the Sahara, and it is literally the worst it's ever been in the last 50 years. And so, I'm sitting here thinking, what else can happen in 2020? I mean, there's a coronavirus, there's been market volatility, there's an election, and then all of a sudden, interest rates have completely tanked inside, basically gone down. And so, I always like to look at positives inside of things when we're looking at investing or people's financial plans. And so I thought, what better to bring in somebody who can help people take advantage of this current market, who is Heather Stevenson. Heather and her team have actually combined for 3 decades of experience in the mortgage industry. They've actually funded over $75 million in loans for people for both refinancing, new purchases, and investment property. And what I think is really interesting is that their team has been recognized by a social survey as the top 250 loan officers in the entire nation. So I thought, with all this interest rate environment going on, let's bring on Heather and see what she can offer for today. So, hey, Heather, how are you doing?
Hey, Reid, thank you for having me. I'm excited to be here.
Yeah. So, what do you think about this plume? Is this like new?
I've been working so much, I haven't even seen the news. So thanks for letting me know about that.
You're welcome. I can only imagine. I mean, I'm an investment advisor, and I get tons of people that are asking me questions about mortgages and refinancing. And I'm like, that is definitely a little bit out of my wheelhouse. And so I thought, I'm going to bring in a leader in the industry. And so I really appreciate you joining us today. So hopefully I can ask you a few questions and educate some folks today during their lunch hour.
Absolutely. Yeah, it's exciting times.
Great, good. So I'm just going to start off right out of the box because I know that I had this question. Is right now, with interest rates where they are right now, a good time to refinance?
Absolutely. For a lot of people, it is. I think that the most important thing to realize is that every single person is different. So one of the things that we do on my team is we take an individualistic approach, and we make sure that if we are going to go down the path of refinancing, that number one, we have analyzed all the possibilities of that and made sure that's the absolute best thing for you to do. We look at your long-term and your short-term goals to make sure that those are aligning with what the refinance can accomplish for you. But certainly I would say general rule of thumb, what we've been telling people is if your interest rate is 4% or higher, or if you're paying PMI, or if you're considering pulling out any cash to pay off other debts, it is a great time to refinance.
So a lot of the families that we service are close to retirement or fully retired. They're not working anymore. And so I've had a lot of people go, well, Reid, I don't really have an income other than my Social Security, and I don't know if this is something that I'm going to qualify for. So, let's say somebody's retired, can they still take advantage of the interest rates where they are today?
Sure. Yeah. In fact, I've done a lot of these types of loans lately. And the number one thing when people come to me in that position is they're not confident in the fact that they can qualify because of their income being a fixed type income, but they have a lot of assets and investments. And so what we're actually able to do in conjunction with the financial planners and such is we can actually take some of those assets and we can annuitize those to give them an additional stream of income on paper so that they can then qualify for the mortgage based on, a different income if they need a little bump in that. But certainly I think that in this interest rate market, it makes sense. If you can purchase an investment property with cash versus if you can purchase an investment property with a mortgage at a 2.75% interest rate, I think that it makes a little more sense to get a mortgage where you have a write-off on that, as well as considering the fact that, your investments are probably making a little bit more than that. So the rates are pretty exciting, and it's shifted the market for sure.
Well, I'm going to be really transparent with the audience today. One of the reasons that I thought about bringing you on was because I reached out to you about the opportunity of refinancing the home that my wife and I live in. And I think what was so impressive for me was that, we've been in this home for a couple of years. I had a pretty decent rate. but you were able to give me an analysis of, you said, okay, if you hold the loan this many years, then you'll be ahead. And then this is how much positive money you're in. So is this something that you frequently show folks?
Yeah, every single person that comes to us for a refinance, we don't just say, yes, it's good, here's your loan disclosures. We actually put on paper for them, and we have some pretty sophisticated software that shows us, is it worth it? What is the break-even point? Because obviously when you're refinancing a home, there are costs associated with that. So you've got title fees, lender fees. If you're going to put an escrow account in your mortgage, meaning if you're going to pay your taxes and your insurance with your mortgage payment, then your loan amount actually is going to go up in order to refinance the home. So one of the things that we look at is, how long are you going to be in the home? Is it going to be worth it? What is the interest rate savings that you're going to achieve versus the downside of there being costs associated with the refinance? And so what we like to do, Reid, and we kind of do this in terms of remaining interest, because I think that makes it the most clear to everyone whenever you look at it in terms of interest, because your principal balance is going to be what it's going to be. So we look at, hey, if you stayed in your 20-year mortgage, because each mortgage has a different term, right? So if you stay in your 20-year mortgage, you have $80,000 in interest remaining on your loan, versus if you refinance to a 15-year mortgage at a 2.75 rate, then you only have 30,000 in interest remaining on that loan. And I really think that's a nice way to look at it and provide some clarity to an otherwise sometimes confusing subject to our clients, because it really provides an opportunity for them to see apples to apples, because it does matter where you are in your loan as to how much interest you have remaining at that time.
Yeah, and I think about that. A lot of folks, when with the families that we're working with, and I'm talking to them about how we do investment management, and like one of the ways that we get return is by making sure that we invest the assets properly, it's properly diversified. But other ways that you actually make return is by not paying unnecessary taxes. I look at this as almost a third step, and you're not paying unnecessary interest to a third party for the home that you're appreciating on. So for some people, what I really gathered from what you said, if I can kind of paraphrase it, is it doesn't make sense for everybody. Certain people it does, but it makes sense to probably get a report and make sure that if you're going to take time off your mortgage, or it's going to save you actual interest depending on how long you have it. Is that?
Absolutely. And Reid, again, we look at every single person individually because we think that's so important. I'll give you an example. I ran across a guy the other day. He was selling his home. His home is worth about $300,000. And he called me and he said, okay, I think we're going to buy a home for about $400,000. So I'm just going to dump all of this money that I'm getting from the sale of my home into the new home. And I just need $100,000 mortgage. And I said, great, absolutely. Let's look at that. So, but after pulling the credit, I looked at some different things that he was paying on at higher interest rates. And so we really do look at the whole person and say, hey, what if we knocked out this, $40,000 in debt over here at a 6% rate versus, and that same 40,000 that you were going to put on your mortgage would have made very little difference, and your mortgage is going to be financed at a much lower rate. So we're able to kind of shift those funds over to that and do a higher mortgage, which ended up being actually a lower monthly cash flow for him, and he's saving several $1,000s in interest long term. So we really do look at the individual and make sure that we're doing the best thing for them.
Yeah, one of the things that I think about, and I've had a few people talk to me about this, they're like, but I'm adding extra years on to my mortgage. And so I think that, that's kind of where the financial planner comes into place. Like, okay, she said it looks good from her side. I think that it's really important that if I'm your advisor, or one of the advisors of our firm looks at, okay, what is the net effect of this on the overall plan, not just on the mortgage. So I think that you're the first step. And I not just with you, but I've had other folks that are thinking about refinancing, rolling stuff in. You got to look at the overall plan, but with interest rates where they are right now, certainly for some of you watching this, it might be one of those good things to take advantage of right now. And as she mentioned, just because you're not working, or if you're fully retired, there are ways that they can create income, which I think is great. So that's good.
Yeah, and one more thing I want to add to that, Reid, is because you said, how many years is it going to take you to pay this off? A lot of lenders have mortgage terms in increments of 5 years. So what do I mean by that? Well, you hear of a 30-year fixed, a 25-year, a 20-year, a 15-year, a 10-year. We actually are able to customize each person's term. It has to be a whole year. We can't do half years. But if you said to me, hey, I'm retiring in 8 years and I'd really like to have this mortgage paid off by then, we can amortize your loan over 8 years, or we can amortize it over 10 to give you a little bit more flexibility. And I can show you how to make extra payments to accomplish that goal. So we really do have a lot of options for people if they want to completely customize the length of time that they're going to pay on their note.
That's awesome. How would somebody know? So we've kind of talked about, is it right now a good time to refinance? How would somebody know if it's a good time to cash out money out of their account? Like, is that a good option for them? How do you explain that to somebody?
Well, basically think of it as a swap for money. So if you have equity in your home, so the way that a cash out refinance works, and I'm just going to use a $100,000 home value to simplify it. If your home is worth $100,000, you can borrow up to $80,000 against it and cash out. So it's an 80% of the value is what you can pull from it. So depending on how much equity you have in your home, a lot of my clients are pulling cash out of their homes right now to do things such as pay off higher interest rate debt, student loans for their kiddos that they've helped with. That's a really big one. And there's something called a student loan cash out that you actually can get at a lower interest rate than a regular cash out refinance because you are paying off student loans with it. There's also people that are pulling cash out of their primary residence in order to buy and pay cash for investment properties or put large down payments on investment properties, because investment property interest rates are a little bit higher than interest rates are on a primary residence. So there's just so many things that you can do with it. And certainly, you know, if you're looking at a shorter term and interest rates are in the 2s or low 3s, it's definitely a good way to consolidate debt or invest in something else.
That's great. You know, that reminds me. I mean, I've had a lot of families that I work with the environment that we're in right now, spending more time at home, really putting things out in their yards. I'm seeing pictures of these amazing gazebos, pools, and you know, really people just taking advantage of where rates are. So I don't think I've talked about this before, but it kind of made me think. I mean, what would be the difference between kind of doing like a cash out refi versus a home equity? Or is that the same?
Totally different. That's a great question, Reid. So what we generally tell people when they call us about something like that is a cash out refinance is good for you if you're either, number one, you don't have an existing mortgage at a lower rate, right? So my husband and I just built a pool. We ended up doing a home equity line of credit because our first mortgage is at a much lower rate than we could have gotten if we had done a cash out refinance. So think about it like this. When you do a cash out refinance, if you owe something already on your home, you're going to refinance that loan in addition to pulling additional cash out. If you are doing a home equity line of credit, you're just tacking on basically like a second lien to your primary mortgage.
Okay, so really depends on their situation, so something that you need to go to an expert like that. That's good to know. Okay. How much money? So I know for our situation, I'm probably sure it's going to be the answer that I get a lot of people is it depends, but how much money do people need to come out of pocket for a mortgage, or if they're going to refinance or do a new loan, what does that look like right now in today's environment?
Yeah, so for refinancing, oftentimes it's zero out of pocket. The only time that you would ever have any money out of pocket is usually if you want to. So sometimes people say, I want to pay my mortgage down to this and refinance the rest of the balance. But otherwise, 99% of our refinances, everything is just financed into the loan amount. So even if you don't have 20% loan to value, meaning if you don't have 20% equity in your home, you can still finance all of your closing costs in for your refinance transaction. Now that's on a refinance. On a purchase mortgage, we have, for those of you who know first-time buyers or have kiddos that are first-time buyers, we have 0 down, 3% down loans. Typical closing costs between $6,000 and $7,000, depending on several different factors, obviously. And then for investment properties, we can do as little as 15% down, but to maximize your interest rate savings, I always recommend my investors do about 25% down on their investment properties plus closing costs. So on a purchase, obviously you're going to be out money. On a refinance, it's virtually no money out of pocket. Everything's just rolled in.
So what about if somebody was, we have a lot of people who have served in the military. So VA loans versus a traditional loan. I mean, you guys do both of those. Is there any
Yeah.
pros and cons versus that on one versus the other?
That's a complicated question. So we look at this a lot, especially with veterans. Okay, so if you're a veteran, you don't want to put money down, there's no question the VA loan's the way to go. The reason why is because there's no PMI on a VA loan. So you can't beat that.
I'm going to stop you right there really quick. A PMI is principal and interest, meaning the reason I'm really familiar on this is just last night I was talking to someone, she might even be on here today because we were talking, she'd be here. Her son is buying a loan a home, and he wanted to make sure that he paid the principal and interest on his own terms. It wasn't rolled up in the loan. So when you're talking PMI, that's what you're talking about, right?
So that is a good question. So PNI is principal and interest, which is your true loan payment. PMI is mortgage insurance.
Okay. And so I got you.
Time you put less than 20% down on any loan besides VA, you're always going to pay mortgage insurance. And so the reason why VA is so amazing is there's no mortgage insurance, no matter what. You can put zero down and still have no mortgage insurance. Where we start to teeter-totter on, is it better to do a conventional loan or a VA loan, is whenever the veteran has at least 20% down. Because the VA loan has an additional little finance charge in it called an upfront PMI that's actually tacked onto your loan amount for most veterans. If you're 100% disabled vet, you will not have that, but for the majority of veterans, they do. And so in that case, sometimes we look at, hey, if you're already not going to have mortgage insurance because you've got plenty of down payment, then let's look at going a conventional loan rather than a VA loan, because we want to eliminate that extra fee that the VA charges.
Oh, wow. I learned something new today. I had no idea. That's awesome. Great. All right. So we've kind of addressed if you are retired, you can still qualify for a loan. I wanted to kind of recap on that a really bit, because annuitization can be a scary word, meaning that and sometimes people think, okay, that means I got to take a payment indefinitely. So what you said is putting that on paper. Can you kind of explain that a little bit more so that they understand that?
Sure. So I kind of tell my clients this. Common sense went out the window a few years ago because there were some lenders that were doing some things that were probably not in the best interest of their clients. So what happened is Fannie Mae, who regulates all of our mortgage loans, had to kind of crack down on the requirements. You used to be able to call a lender and say, hey, I make $5,000 a month and I want a mortgage. And the lender would go, okay, great. It's a stated income loan. You just get the mortgage. Well, they said that's irresponsible lending, and I agree. So Fannie Mae says now we have to prove every stream of income that comes in, and it's all about ratios. So if you have $10,000 coming in, you can't have more than $5,000 going out. There's a debt ratio there. So what happens when people are retirement age is they live on a smaller budget monthly, right? So their income revenue monthly is a little bit lower, but they have all these assets that they can tap into. So instead of using common sense and going, oh, okay, well, there's a lot of assets there. We can, obviously they're going to repay this mortgage loan. We still have to go by the ratio. So what we do is we take some of those assets and annuitize them. So annuitizing means just taking a chunk of that asset and pulling it off in monthly payments, essentially. And so when we do that for a mortgage loan, we just do it. So I'll call Reid and I'll say, hey, Reid, Miss Jones needs an additional $2,000 a month in income to qualify for this mortgage. Can you annuitize one of her assets? Reid will say, sure, no problem. He'll take one annuitized payment and send that to Mrs. Jones. We'll get a record of that. And now we have an income stream for Mrs. Jones to qualify her on paper for this mortgage loan. And once we have one of those distributions and we've shown that, we can close on the mortgage loan and we're done. Now, whether or not Ms. Jones intends to proceed with that or not, no one will ever know after closing, right? So at that point, you can choose to continue that annuity, or you can choose to, stop that for whatever reason and just pull from your funds as you need them, if you need them. But there are certainly people who look at it both ways, and you do not have to continue. Once the loan is closed, the loan's closed.
Yeah, and I want to make sure that I clear that up. It's kind of that it's that the lending provisions that happened back after 2008. I mean, there was just a lot of people that didn't have the amount of assets, but they were making creative lending ways. And so, here I have people who, for example, might have $1 million and their income is maybe $2,000 because they're frugal and they want to buy a new house. They just have to show that one payment. It's not like they could take more than that 2,000 if they wanted and probably have enough for the rest of their life. But is that kind of what you're saying? Is that
Absolutely.
a lot of
Yes,
people payment
absolutely.
going, they can, but they just have to show some sort of payment. They don't have to continue doing that. That's great.
That's correct.
And I wanted to remind you guys, we are a little bit ahead of schedule. So if you want to ask a question, you can. We got a few more that I would like to ask Heather, and then I'm going to try to get to a couple of the questions that I've seen come in here already. So, all right. So here's stuff that I love talking about is retiring and having fun and vacation homes. I have a lot of families that are talking to me about this with where interest rates are. So how can you purchase a primary vacation or investment property? We talked about with the no income. How does that work with today's environment, though? I mean, as far as where interest rates are, you talked about interest rates being a little bit different. Is it harder to qualify? What does that look like?
So that's a great question. So vacation homes we refer to in the mortgage industry as second homes. So anytime I've got one right now, someone's buying a cabin up in Broken Bow, Oklahoma. They are doing it as a second home because it has to be a certain amount of miles away from your primary residence, kind of qualify that. Usually it's 100 miles and, reasonably speaking would be a second home. And so the minimum down payment requirement for a second home is 10%. So it's actually not that much. And then also the interest rates are exactly the same as your primary residence. So you're not going to pay any additional interest rate for purchasing a second home. And then, if you choose to stay in it several weekends a year and, down the road, you choose to possibly, rent that out, that's something that happens down the road, but your second homes are no higher interest rate than the first home.
But if you do choose, if you are buying it strictly for an investment property, you're planning on like Airbnb-ing it or something of that nature, what does that look like?
So that would be an investment property. So if your intention at the time of purchase is to use that property not as your own second home or vacation home, but as a rental for someone else to go vacation there, then yes, that would be considered an investment property. That would trigger the 20% down.
Okay. How do you know, like with interest rates this low, how do you figure it out? I mean, we have software, right, where we do this financial plan and we show people like, okay, here's the probability of this plan making it work. How do you guys determine if without putting a financial advisor in the mix, if a rental property, if investing, it's going to be a good option for them?
Yeah, we always recommend that they consult with their financial advisors. About as far as we get into it, Reid, is to show them a rental schedule from their appraiser. And part of what you do whenever you're purchasing an investment property is you have a special appraisal done that kind of shows you not just the value of the home, but what the rental potential is of the home. And so sometimes, if you're in a vacation area, it may look very different, meaning, average number of weeks that people rent their homes in this area is 36 out of 52, versus if you're buying in rural Dallas or something just outside of Dallas, just for a single family rental home, they're just going to tell you, hey, average for this size home rent is $1,800 a month. And then you can take that from there and say, hey, how much could I rent this for versus how much is it going to cost me? And what kind of reserves do I need to have? But certainly speaking with your CPA and your financial advisor whenever you're looking into those is really important, because there are a lot of tax implications that can be helpful when you own rental properties as well to take into consideration.
That's great. So here's the $1 million question. I mean, a lot of people are, some folks are like concerned about where interest rates are. I mean, I'm having a lot of people talk to us about like, if I have money in the bank, I really don't have any interest going in here. Are you guys getting, at least in your industry, any word on what direction they think interest rates are going to go? Are they here to stay for a long time? Or they, what are,
I tell my clients every day, if I knew that I wouldn't be working, I would just go to Vegas or something. But generally speaking, the interest rate market has been really stable for the last few months. We have seen historic lows since about February, March timeframe. They continue to be low. Do I think they're going to go lower? I don't know how they could. I mean, we're we're at a 2.75, rate on a 15-year note with an 800 credit
With
score.
somebody making money, on that, right? So it's fair.
Yes,
Yeah.
exactly. But I will tell you this, history repeats itself. And I don't know if anybody remembers what happened in 2016, but we had an election year, and the summer of 2016, we experienced Brexit, which is when I got my, really amazing 2 point something percent interest rate on my mortgage. But that was a very short-lived time period. But the mortgage rate stayed really low until literally the day after the election, and they shot through the roof. So I don't have a crystal ball. I do know that history tends to repeat itself. I would highly recommend that if you want to make a move, that you start to look into doing that probably prior to the election, because there's such volatility involved in the market after any election that I would not take the chance of waiting.
Okay, that's good. Great. All right, I'm going to try to get to a couple of these questions here. Oh, that's a good one. So Jeff and if you don't know, I don't know, I'm not familiar with this act, but Jeff and Mary are asking, what do you think about the impact will be to investors that own interest in apartment buildings if the HERO Act is passed? Are you familiar with that? Do you work with multi?
We don't. So I am a residential mortgage lender. So that's more of a commercial mortgage lender type question. And I will definitely stay in my lane on that one and not get into that. But we could probably link you guys up with a commercial lender to help answer that question.
That's what I was going to ask, is do you guys have access to a commercial lender? So I think that at the end, I'm going to give Heather's number, and she can give you somebody that she'll recommend that she works with. So I apologize, Jeff and Mary, that's one that we don't have, but let me ask a few other questions here. Oh, okay, this is a great one. What options are now to finance land-only purchases?
Yeah, so land only is a cool thing. It depends on what type of land it is, how much land it is, but typically you're looking at 20% down on land. And then if it's undeveloped land, like a lot of acreage, sometimes the banks will require as much as 35% down. Land loans are a higher interest rate, usually in the 5 to 6% range. But what a lot of my clients are doing right now is they're buying land, putting the big down payment on the land, then they're building and we're doing their construction loan, and then we're getting them locked in for their long-term permanent financing once the construction's completed.
That's great. I'm personally looking at land as we speak right now, so that's good to know. That's great. Let's see, we got Mr. Salazar asks, is PMI based off of the amount of the home? If so, is it a percentage, and what is the percentage?
That's a great question. So PMI, let's see, the best way I know how to explain this, if you guys are familiar with like an XY axis, okay? So PMI for a conventional loan, totally different, throw this out the window for government loans, but I'm assuming you're talking about conventional PMI. It's based on two things primarily. One is the loan to value. So how much money, how much equity do you have in your home, or how much money are you putting down? So your highest PMI rates are going to be at 3% down. Then you get a little better at 5%, a little better at 10%, a little better at 15%. Okay, and they go in those increments. There's no in between. Then on the other axis, you're going to have your credit score. So if you have anything over a 760 and you have 15% equity, you're going to get the very best PMI rate. So if you think about that XY axis, your 3% down is at the top, and your 680 score is right next to it. That's going to be the highest PMI rate available, right? You go all the way into 15% down and you've got an 800 credit score, you're going to get the lowest PMI rate available. So it's a sliding scale on kind of that XY axis, if that makes sense. So it depends on.
So it depends. When I was doing the radio show, that's why I said I should call it depends. It depends on the situation. Mm-hmm. He also asks, are closing costs less if you pay cash?
Absolutely. Yeah. So you're going to save on two things whenever you pay cash for a home versus getting a mortgage. One is the lender fees, because if I'm not involved, you don't have to pay lender fees, right? Most lender fees across the board, I would say about $1,300 to $1,400 are very standard for lender fees. So you would save that. And the second thing that you would save on if you paid cash would be the title policy. So whenever you're paying cash for a home, you want to buy an owner's policy, which is depending on the price of the home, right? And then if you are getting a mortgage on a home, you have to pay the lender's title policy if you're refinancing. Now, if you're buying, that's something that the seller pays. But yeah, those are two fees that aren't there and aren't involved unless there's a mortgage.
Now, for those of you that are thinking about refinancing, something that I learned from Heather and her team was I had a 2-year home and I remember that title policy being very expensive. And I was like, oh, I don't want to go do this. That was the first thing that was in my head. And you get discounts. I think, is it up to 7? How many years is it?
Up to 7 years. So for the first 2 years, you get a 40% discount. The third year, it's like 35%. So they've really regulated that a lot because those title policies are really expensive. And so when
Yeah.
people are refinancing, I did one today. His original loan was 269. His new loan is 250, and his original title policy was like close to 2,000. His new one is 740. So very big discounts, and you want to make sure you're working with a lender that understands that, because if the lender doesn't advocate for you at the title company level to make sure that they're giving you that, it's called an R8 credit, you won't always get it. Also, important thing to know, you don't have to close at the same title company that you did on your original purchase. You can close at any title company in the state of Texas. It's a Texas law. It's called an R8 credit.
But I will tell you what I learned through this experience is not everybody does that or advocates for that. So I thought that was really good that you guys brought that up. So I wanted to bring that up since we have talked about where rates are. And Mr. Salazar had one more question for you. Are there a lot of first-time home buyer programs right now with the new structure in the?
So yes and no. So the first time home buyer programs basically are allowing you to put less money down than most people would be required to put. So for instance, Fannie Mae says that if you're not a first time home buyer, you must put 5% down in most cases, minimum. If you are a first time home buyer, Fannie Mae allows you to put just 3% down. Okay. So that's your biggest one right there. You don't have to be a first-time home buyer to qualify for an FHA mortgage. That is a 3.5% down payment. You also do not have to be a first-time home buyer to qualify for a USDA loan, which is a rural loan kind of outside of the city limits of most places. You'd have to check with me to see if the area is eligible. You do not have to be a first-time home buyer to do that, and it's a 0% down loan. The first-time buyer programs that are like the ones that you can get money basically towards your down payment and closing costs, the majority of those have been suspended due to COVID, but we do see those coming back here in the next 6 to 8 months, hopefully as the economy starts to come back.
So it's not as feasible as it was before, but there's still a couple of things that are out. It probably just gave a call
Yes.
is what it is.
Yes.
The last question, and again, we got a couple more minutes if you want, or if you got that here, I did want to make sure I got this, was Mr. Barnes asked, do you think it's feasible to refi if we've already have a 3.9% 30-year fixed?
Absolutely.
Yeah, especially if you're getting the twos right now, that might make sense. That's good.
Absolutely. And there's so many reasons why, and we can talk about it offline, but the bottom line, what I want you guys to know, anybody that's thinking about refinancing, is we consult with you free of charge. There's no charge to do that. The thing that we really like to have from you is an application, which we'll send out a link to that after this is over. And then we also like to have a copy of your most recent mortgage statement. It tells us so many things that we need to know. So we ask our clients, put in your application, just fill it out online, or one of my colleagues will call and take that information from you, and then send us a copy of your most recent mortgage statement. And then give us a few days, because we spend a tremendous amount of time working up these scenarios for you. We'll talk to you and find out what's important to you. And then we'll set up a consultation with me where you and I will go over one-on-one the analysis that we've put together for you, so that we can talk through all the logistics. I will explain everything and more than you ever wanted to know about refinancing and the whys. And if you're not 100%, if it's not going to 100% benefit you, I'll tell you not to do it. I talk people out of refinancing all the time. So.
And one thing I want to point out too, if you notice Heather's unique background there, she's actually at one of her investment properties today, and she was already she's in East Texas right now. And so I want to really thank her for doing this. So she actually does know about investment property as well. So I asked her, she was like, we changed it, but we wanted to make sure we got this June lunch and learn. So I appreciate you doing this kind of out there.
Thanks for having me.
One last question I have, as somebody has mentioned, is that they've been single for 9 years. Do they qualify for a first-time home buyer?
That's a great question. So it's not about your marital status as much as it is about, have you owned a home? So if you have not had any ownership in a home in the last 3 calendar years from the date of your mortgage application, then yes, you qualify as a first-time home buyer.
So even if somebody maybe had a home joint and then they've been, so in this case, I don't know her situation, but let's say she's, 9 years. So then that would have a first-time home buyer program? Wow, that's
Correct. Yeah, absolutely. You can own 10 homes and you sold the last one that you've ever owned 3 years ago, and now you're automatically a first-time home buyer again, and you qualify for those lower down payments.
I keep learning new stuff from you all the time. Thanks for that.
Yeah.
Well, I want to thank everybody again. Oh, wait, I have one more? I'm just thinking a little bit more. What is the interest rate range for first-time loan buyers with good credit?
Well, that's going to be that depends question, because I mean, good credit is, what is it? 720, 820. How much are you putting down? What type of program are you going with? I'll tell you this, our FHA rates right now are unbelievable. No points with good credit, no points, 3.5% down. It's 2.875. It's unbelievable. That's on a 30-year note.
Yeah, no, that's it. We've never seen it like this before. And you can actually pay, as you were kind of explaining to me when I went through your analysis thing, is if I wanted to pay to get lower percentages, and then you showed the amortization for that as well, right?
Yeah, and discount points are a whole nother topic that we could stay on forever, and we may not have time to do that here, but discount points are really cool. And that's one of the things I educate everyone about whenever they're doing a loan with us. You will know what a discount point is and why you would buy it and why you wouldn't, and why it's right for you or not right for you by the time you're done.
That's great. Well, Heather, I really want to thank you so much for taking the time today. I want to give everybody the opportunity that kind of wants to sit down with her. We've had a ton of questions, and Heather's blocked out for Lake Point clients and referrals of Lake Point clients some time slots on our calendar throughout the month of July. So we're going to give you the opportunity to sit down with her. If you guys got a pen and paper handy, I'm going to give you her phone number. We're also going to give you her email address right now, so you can reach her either way. But more importantly, if you don't have a pen and paper, I have a lot of clients that are driving. I hope you're not doing that. But if you're just not by something, you can also contact myself or one of your advisors, and we'll get you this information. But Heather's email address is hstevenson, STEVENSON @sfmc.com. So Heather's hstevenson@smc.com. Her number is 972-961-3566. Heather, I can't thank you enough again for taking the time today. So great. And folks, I appreciate you guys being a little bit interactive today. And know things are kind of crazy out there. It is an election year, but we're here to try to continue to educate you. And if you have any questions about anything we talked about today, feel free to reach out to myself or one of your advisors, and we'll look forward to seeing you at the next Lunch and Learn. Thank you guys so much. Have a great day.
Thanks, guys. Really appreciate it, Reid.
Bye-bye. Take care.
Bye-bye.